Welcome to our series of recap videos and to our introduction to accounting course. Now let's turn our attention to when we have fixed assets in involvement here and how it impacts on the three statements. Now when we purchase an asset, so assuming we purchase an asset of 2,500, you realize that it has no impact on income statement, but there is full impact on the balance sheet and the cash flow. Once we purchase that, we will reduce our cash, obviously, because we will purchase it with cash, 2,500. So there will be a cash outflow of 2,500 in the investing activity session. Like I said, the investing activity session seeks to reconcile everything in the long-term assets. So that's also visible here. Now, when we purchase that, our net PPE, which is our property, plant and equipment, will increase because obviously we have bought an asset and the value of the asset is 2,500. So that will increase the net PPE by 500. And at this point, because we don't have anything here, our cash flow has also reduced by 2,500. So our balance sheet still balances at zero, because our cash flow is in the negative, because at this point we don't have anything, but we've been able to buy an asset of 2,300. So these two will cancel out, and then we still have our asset balancing. Same applies if we buy another fixed asset, that is goodwill. So if we buy it, we will charge it in full in our cash flow statement, and then also it will show us an acquisition, an increase in goodwill, because we have bought the asset. That's 1,000. If we buy another intangible asset, it follows suit, same way. So we pay for it here in our cash and charge it here, and the balance be in our balance sheet. But then this will knock out the negative 5,000, so we have negative 5,000 here, cancelling out, and the balance sheet still balancing. Now, when we buy an asset, what you should know is that it has no impact on income statement unless we depreciate it. So once we depreciate it, then we seek to charge the cost of the asset over the useful life as depreciation. So let's say if we purchase this asset for 5 years and we charge depreciation on the fixed asset, we will have purchased a PPE of 2,500, all right. But because we are assuming that the asset's useful life is 5 years, and so we want to charge in equal amounts over the 5 years to the income statement as depreciation, it means that we will have it as a notional charge, and that's why we say a notional charge. It is actually not a cash flow, because the cash element has been paid off already in our cash flow statement. But what we are doing here again is for the purpose of decision making. We are seeking to know how much of this asset has been applied in generating income, and that's why we spread the cost of the asset over the useful life and charge notionally, right? Assuming you are applying it. This is for the principle of matching. That's why we do that. We notionally charge 500 as an expense to the income statement to reduce our profits and see what will be. It's purely for decision making. But when you come back to the cash flow statement, this net profit here will feed back into the net income in our cash flow. And then you need to add back. That's the reason we add back, because the cost of it has already been charged. So if you charge it again, if you allow the impact flow through the net income without reversing it, what it means is that you are doing a double count. And that is why we add back these notional charges, the depreciation and the deferred income taxes. They are notional charges. They are charges to the income statement, but they are not real cash outflow, and that's why we call them notional charges. It's purely for decision-making purpose, and that's why we do that. Now, that reversal will happen here, so it will keep it flat, and then we'll still have our cash being negative -5,000 because of these purchases we have made being here, and our total assets being 4,000. Now you see that our net PP balance has reduced by 500 because we believe we have used up 500 of it in the current year, so we have charged it as depreciation to the income statement, and so the balance that stands in our books will be 2,000 instead of the 2,005, because 2,005 we bought it and we believe we have used 500 elements of it, and then our cash, our total assets become negative 5,000. We still have negative 500. We still have our depreciation charge here being, at this point it's just purely about the linkages, so forget about the fact that the balances are negative and whatnot. We just want to see the movement, and that's why we have it the way we have it. So it's same for goodwill. If we seek to amortize goodwill, so the same way as we depreciate fixed long-term fixed asset, we also amortize goodwill in that same manner. So we believe that this goodwill will last for some 5 years. So it was 1,000 before, we bought 1,000, divide by 5 will give us 200. So it means we have also charged additional 200 to it as amortization, making our depreciation amortization balance coming to 400, and then the balance in the goodwill account in the balance sheet also reducing by 200, bringing the balance to 800. So same principle applies, and our balance sheet still balances. The same way, if we are amortizing the intangible assets by 5 years, we are seeking to write them off over 5 years. We bought it at 1,005, we divide by 5, so which means every year we will charge additional 300 to the 700 that already existed from the goodwill, net PP, depreciation, amortization, and then we will have our balance reduced from 1,005 to 1,002 and still balances. So this is how the impact. So always remember that when you make any purchase of a fixed asset, it has no impact on the income statement unless you depreciate it. So if you don't depreciate it, it will only rest within the balances here in the balance sheet and being accounted for in our cash flow statement. Thank you.